Now, I will teach you how to invest your first $1,000 and be on your way toward financial freedom. What is an investment for your first $1,000? Well, investing is a great way to make money. Investing for your first $1,000 is a great way to get started. There are many different ways to invest, and there are many different things you can invest in. It all depends on your risk tolerance and what you want out of the investment. The most popular investments for your first $1,000 are stocks or bonds because they have been around the longest and have been proven to work well over time. Stocks and bonds are considered low-risk investments because they give you the chance to make some money with a small amount of risk. They are also considered passive investments. This means that they don't require a lot of effort, knowledge, or time. You don't have to worry about going out and finding stocks on your own or selling them. First, you can invest your money in an index fund. Index funds are mutual funds that track a market index. Investing in an index fund is like investing in the entire stock market. When you invest in an index fund, the money goes to all of the companies within the index, which means it's more diversified and less risky than owning individual stocks. The biggest advantage of investing in an index fund is its low cost. Index funds don't try to beat the market, so they generally have lower fees than actively managed funds. The best way to invest your money is by putting it into an index fund that tracks a broad-based national or global stock market index such as the S&P 500 or MSCI EAFE indexes. For an even more simplified strategy of investing for beginners, consider target date funds. Target date funds are a type of mutual fund that invests in stocks and bonds and automatically shifts the investment mix over time to become more conservative as the target date approaches. The idea is that you can get started with investing without worrying about all the details. The investments shift to become more conservative as retirement approaches, so you don't have to worry about making changes or managing your portfolio yourself. You also can invest in exchange-traded funds, ETFs. Some mutual funds require high investments. This is where ETFs are better as they have a lower minimum share price. There are ETFs for all sectors and passive index fund ETFs. Investing in ETFs is a better way to invest than investing in individual stocks. The ETFs are diversified, and they can be bought and sold like stocks. There are many reasons why you should invest in ETFs instead of individual stocks. First, ETFs are less risky than individual stocks because they are diversified. Second, you can buy and sell ETFs like stock, which means that it's easy to get into and out of the market quickly. Third, there is no need for a broker when you purchase an ETF, which makes it cheaper for investors who don't have much money to start investing. Pay attention to no transaction fee funds. No transaction fee funds are a great way to save money on investment fees. These funds won't charge a commission or trade fee when buying or selling stocks within the fund. Investing in these funds will keep more money in your pocket and allow you to invest without limitations. As a beginning investor, the cost is tremendously important, says Guy M. Penn, principal at St. Louis Private Advisors. If every week you were to invest $100 and purchase a security with a $7 trading fee, you're immediately down 7% on your investment. To avoid transaction fees when investing, check to see if your fund has no transaction fee. Funds that are popular among larger investment firms often have a list of ETFs and mutual funds without a trading fee. Find a financial advisor for your money. There are many financial advisors out there, but finding the right one for your needs can be a tough task. Here are some guidelines to help you find the right financial advisor. 1. Ask yourself what type of advisor you need. 2. Check their credentials. 3. Check their professionalism. 4. Ask for referrals. One of the best things a beginner can do is find an expert who can help you understand your finances. A good financial advisor will offer an explanation that's easy to understand, Be clear about how they're compensated, and then follow up with a plan tailored to your needs. A $1,000 investment is a great start, but it can also be helpful to have someone to guide your next investment. What is the difference between stocks and mutual funds? Stocks are shares of a company that you can buy and sell on the open market. Mutual funds are investments that pool your money with other investors for investing in stocks, bonds, and other assets. There are two main differences between stocks and mutual funds. 1. Stocks represent ownership of a company, whereas mutual funds represent ownership in a pool of assets. 2. Mutual fund investors get to choose which stocks they want to invest in, whereas stockholders have no say in what companies their shares are invested in. How much should I invest my money in stocks or mutual funds? Keyword: investments for beginners. Investing money in the stock market or mutual funds is a big decision. Many factors go into it, and the answer to this question depends on your risk tolerance and time horizon. You need to understand the different types of investments for beginners. These include stocks, bonds, mutual funds, ETFs, real estate investment trusts, REITs, and commodities. A stock is a share of ownership in a company that can be bought and sold on a public exchange like the NYSE or NASDAQ. A bond is a debt security issued by governments or corporations with interest payments due at regular intervals until maturity. Mutual funds are pools of stocks that investors buy shares in so they can diversify their holdings without having to buy individual stocks themselves. ETFs are similar to mutual funds. So, the conclusion: the best investments for beginners. Index funds. Target date funds. No transaction fee funds. Exchange-traded funds, ETFs. Stocks. Or finally, get a financial advisor.